watching The Money Show on ET Now's Rise with India Primetime segment with me, Mubina Kapasi. This is the show where we say assuage your fears, which I'm sure a lot of you are feeling at this juncture, given the coronavirus pandemic. And if you're looking at the equity markets, then of course you have all the more reason to fear because the markets have been whacked out of shape, as has been the case with a lot of mutual funds as well. However, is this really an added reason to panic apart from, keeping yourself and your loved ones safe? How much should you worry about, the whiplash that your mutual fund portfolio as well may have received because of the crack in the equity markets? That's what we will be discussing as always today on the show. And I'm sure you may be having questions and queries with respect to your portfolio as well. In just moments from now, we will turn on our phone lines for you. You can call in on 24990300 and get any queries answered by our personal finance expert. And just as we speak, you can see the news flashing on your screens. It's yet another somber piece of news. India officially has seen the fourth death due to the coronavirus pandemic. Just waiting for where this individual is located, but do remember we have one case of a death in Mumbai. Delhi and Karnataka are where the other two individuals have passed away. Just waiting for where this death has essentially happened, but we don't know that yet. But yeah, it's the fourth death in India due to coronavirus. Just a message for all our viewers. Please keep yourself within adequate physical distance. Quarantine yourself at home. These indeed are testing times. And it's testing times for the financial markets as well, especially for you, the investor, the viewer of The Money Show, because I'm sure a lot of you guys, every time you open your CAMS statement or you look at your portfolio, your NAVs have crashed. What the value of your investments was just a couple of months ago versus what it is now. There's a drastic difference. Many of you may have actually seen your capital as well deplete to a significant extent. But the question is, what should you do? Is now the time where you halt? Should you increase SIPs, taking advantage of the low price, or should you decrease the amount of your SIP? We will be getting these questions answered today. Joining us on the show is Harsh Roongta, personal finance expert. Harsh, always a pleasure having you with us on The Money Show. Today was another day where we saw the market fall. The Nifty 50 went below the 8,000 mark as well before recovering a tad bit. And the government seems to be doing their bit. In fact, all across the country, all across the globe, we have central banks pumping in money into the equity markets, pumping in liquidity, trying to provide some support to businesses, to economies in general, but clearly markets don't seem to be reacting as such. Now, in the midst of all of this, you have the retail investor, the mutual fund investor. I'm hoping the equity MF guys are all long-term investors. As they see this massive 5,000 point crash from 12,000 to, just 8,000 odd, or just 4,000 point crash, pardon me. What do you recommend they do? Is this the time to put a pause on their SIP, or should they take advantage of the lower price and increase it, or even for that matter, decrease the SIP amount?
So I think basically this very extremely serious episode or what is happening to the entire world, I think it lays down the importance of how you ought to invest after planning, how you ought to do goal-based planning. And typically, if you would have done that, your equity investment, whether existing or ongoing by way of SIP, would only be for those goals that are still 8 or 10 years away. You would not otherwise be investing in equity. And I think if you have done that, then you have less to be concerned. Then people who do arbitrary investments, depending on what they hear, what they do. To answer your specific question, I think it would to treat this thing as a just as another opportunity where the market has gone low may not be correct, but at the same time to be paralyzed also is not going to be correct. So what ought to you to be doing? I think if you're already having a SIP that is going on, then obviously I think you should continue that SIP in the equity. Don't stop. This is not the time to stop. The If you have, I've written today, if like me, you're moving some money from debt to equity. Uh, uh, I was doing that myself. I was doing it for a few of my clients. Maybe this is a good time to accelerate the shift from debt into equity. So what I have done in my own case is that instead of having it as a monthly STP, it is now a weekly STP. So I'm not still taking a call on whether the market has reached the bottom, etc. I don't think anybody can predict that. Uh, but the whole idea of doing it on a systematic basis is that you don't need to predict. And since I don't need the money, or the investor who are investing in equity do not need the money, it is not borrowed money, I think the ability to wait out and make sure that you still build for the long term is pretty good. So I think the point is you should not be afraid. You should continue perhaps to do the right things that you were doing. Maybe accelerate the shift if you were shifting from debt to equity. But otherwise I think holding your nerve is the main thing to take us through. That applies to investments as it applies to our personal lives as well. I think we are in unprecedented times, and clearly holding our nerve against an enemy that you can't see, can't touch, can't feel. I think holding our nerve and behaving and taking all precautions is the best that we can do.
Okay. Well, yeah, that's extremely important to understand, because one thing to understand is, unfortunately, this is not the first or the last time that we will see either man-made crises, or for that matter, even crises like the one that we are facing right now. I'm talking about epidemics in the past as well. We've seen the avian influenza, pardon me. We've seen the SARS epidemic as well, and coincidentally, SARS incided with the entire fall of 2002-2003. But again, if we look at the markets compared to what it was in 2002-2003, and now obviously there's been a marked rise. Okay, so Mr. Roongta, just to essentially summarize your first answer, you recommend that if I'm doing an SIP of, let's say, 10,000 rupees, 15,000 rupees, whatever it is, I should not pick up the phone and call my broker or my distributor that, listen, you know what, just hit the brakes on my SIP for this month or for the next month, and you should just sort of continue with what's going on. And obviously timing the market is out of the question. That's the reason why you have an SIP.
Absolutely, you should continue the same, and as I said, if you're doing shifting, you can accelerate the shift from debt to equity.
Okay. Mr. Roongta, I want to talk to you about that whole debt bit. We always speak about diversification, right? That does not mean just flooding your portfolio with, 10 and 15 kinds of funds. When we speak of diversification, we are also talking about ensuring that there's debt in your portfolio. Now, first, we've obviously seen debt as well being hammered out of shape. Yields are at, record lows across the world. If someone does not have exposure to debt, and I think that's quite common among a lot of our viewers, because debt is any which way is very jargony, difficult to understand, do you think they should ensure that use this opportunity to ensure that your portfolio has a certain percentage of debt?
So I think in general it is a good idea to have some debt in your portfolio. Even the most aggressive investor needs some debt in their portfolio. Typically for those who are working, I think the debt comes from the employee provident fund, etc., which you may not count, but it is very much there, and it forms a significant portion of your investment corpus that you are generating. But otherwise, those who are self-employed and do not have the employee provident fund, etc. For them, some amount of debt should be there. Again, I think, I mean, there is no opportunity as such currently. I mean, today, as you yourself said, debt is at a record low. So I would not recommend that you buy long-term debt, but definitely you ought to have debt. And I think for the lay investor, simple debt makes a lot of sense. So if, for example, if you're a senior citizen and if you don't have debt, every senior citizen, if he has the funds, must have a senior citizen saving scheme. 15 lakhs are allowed. It should be there to the extent of his debt allocation, or 15 lakhs, whichever is lower. I think it gives 8.6% taxable, but guaranteed by the government. So I think clearly that should be there. For people who need regular income, again, you have some senior citizens. You would have PM Vay Vandana Yojana, which of course is there only till March 31st and will probably come back, but with a lower rate post March 31st. Even for those who are not senior citizens and therefore cannot take advantage of this, you have debt schemes like the Bharat bonds, for example, the PSU debt bonds. So you have the FOF where you can conveniently take exposure. And I think you have both the 3-year 2023 bond and the 10-year 2030 bonds. I think again that's a lovely exposure where there is of course a little bit of interest rate risk, but you don't have credit risk, or you have very low credit risk. And again, that is an exposure that even non-senior citizens should take. I would not say this is the opportunity, but you should definitely have debt in your portfolio. Even the most aggressive investor should have some debt in his portfolio.
Okay, well, that's of course talking about debt, and it's important that you lock in your interest right now, because I suppose come the next quarter, the 31st March quarter, I don't think the government's going to keep these small saving schemes interest rates as has been the case for the last 3-4 quarters. I'm pretty sure that they will be revising the interest rates lower. All right, let's take on board our questions and queries then, and let me remind our viewers that if you have any queries, you can call in. The numbers appearing on the top of your screens, 24990300, and of course, Mr. Harsh Roongta is here to get your questions answered. Okay, well, let's take on board our very first query for today via email. Kunal Batra writes into us saying that I recently invested in the Axis Blue Chip Fund through the Grow app. However, this slowdown makes me worried about the long-term returns. I invested around 10,000 one time. Okay, I think he's a very small investor. He's just put 10,000 rupees, and the fact that he says one time makes me believe that it's probably a lump sum investment. And he's not given his entire portfolio. He's just written that he's invested in one fund, that's the Axis Blue Chip. Just request to all our viewers that it's always a good idea to send your entire portfolio so that our viewers can take a holistic approach. Okay, Mr. Roongta, your view, I mean, should viewers like Kunal be worried?
See, again, it goes back to why did Kunal invest? So, first of all, is it goal based? I don't think so. From the tenor and tone of his email, it doesn't look like this is some sort of a goal based, because any equity investment that you do, it seems to be a recent investment. Any equity investment that you do, you're bound to have returns that will go up and down, and you're bound to have periods and maybe extended periods during which your capital will be less than what you have put in. But past analysis of past data suggests that if you have held on to your equity, or you did continuous regular investments into equity, at least for 8 or 10 years, then it has always given good returns in the past. So I think unless you have that kind of a mindset, or unless you have it for a goal, best is to do it based on your goal. Unless your goal is 8 or 10 years away, I think it is not good to take exposure to equity. And when you take exposure to equity, you have to be mentally prepared to look at your prices and even capital values being negative, that goes with the territory. As the old saying goes, if you can't stand the heat, don't be in the kitchen. So I think equity and negative capital in short periods go together, and equity and good returns in the long period also go together. I think you need to be aware and conscious of this fact, more so during such difficult and trying times.
Okay, all right. Kunal, I hope this has helped you out with your question. Let's move on and take on board our next query. It's coming in from Mr. S.D. Gopalakrishnan. He asks, how frequently are the components of mutual funds updated, particularly the short-term duration funds? I think he means the fact sheet. Also, what's the impact of the RBI's proposal to buy large quantum of government bonds to ease liquidity on liquid fund returns? So, okay, I think what he means is also the whole forex swap and the LTRO that was announced by the RBI just about 2 days ago. So yes, interesting question on liquid fund returns. How will essentially RBI action, move the needle for liquid funds? Mr. Roongta, over to you. How would you answer to this?
So I think if he is asking about net asset values, that obviously I think everybody knows it's updated on a daily basis. As far as portfolio disclosures are concerned, almost every major mutual fund does it monthly. I think they're required to do it quarterly, but I think to the best of my knowledge, every fund house is doing it monthly. And I think the fact sheet is also updated monthly. And there are several places from which you can do an analysis of a particular fund in which you have invested. So I think in terms of what you have got into, what you are getting into, the mutual fund industry today presents probably the most transparent basis of investment. You know what kind of investments they can do. There are limits on exposures to individual industries, to individual groups. There are limits on remuneration. I think the entire structure is extremely investment friendly, and I think we can claim with some justification that the Indian systems on mutual fund are probably leading the world in terms of transparency. Very, very clearly, I think we have among the global best in terms of transparency. Coming back to the impact of on liquid funds, so the advantage of liquid funds is that it will give you the return of the day. I mean, maximum maturity that a liquid fund is allowed to invest is 91 days. It cannot invest in any instrument that has a maturity of more than 91 days. And therefore, even if there are huge interest rate movements, at most it will affect your returns for 30 days or 45 days. But otherwise, you will get whatever is the market return that is prevalent. And obviously, in the current scenario where liquidity is being provided by central banks, including our own, in many, many ways, I think we will see returns from liquid funds fall going forward. Very clearly, we will see liquid fund returns falling going forward.
All right, so that's what Mr. Roongta believes could happen from here for liquid funds. And yes, of course, India's financial system, especially when it comes to mutual funds, enjoys one of the best practices, most transparent as well. NAVs are of course available, at the end of every day. Let's take on board our next query. Ron Coutinho writes in to us saying, I'm a senior citizen who wishes to consolidate his portfolio. Mirae Large Cap, Canara Robeco Emerging Equities, SBI Hybrid, Kotak Standard Multi Cap and the Nippon Small Cap are the funds that he has, and he wants to in fact retain and increase his exposure as well by exiting other funds. There's the Nippon Hybrid, ABSL Hybrid, IDFC Infra, LNT Infra and HDFC Hybrid, as well as HDFC Balance Advantage. So these are the funds that he wants to remove, and he wants to increase it in the funds that I mentioned before. the goal is wealth creation over the long term. He can stay invested. His pension income coupled with investments from fixed deposits cater to his monthly expenses. Now he wants to know if it makes sense to exit at this juncture on the premise that we'll be re-entering at the same time. Basically exiting at low NAV and buying again at low NAV. Is that a prudent option? So basically, is now a good time to rebalance or whatever, revisit your portfolio, make those chops and changes? Now, I just want to mark one thing. He's already a senior citizen, which means he's already 60 years old and he has these funds. So Mr. Roongta is, he's not giving us the amount. He's not told us how much is in the debt bit, that's the fixed deposits and, the pension income, and how much is he actually putting in these mutual funds. But yeah, your word of advice over there as well?
So first, as you yourself mentioned, I think whether he should have equity and to what extent. So I think even senior citizens would need some amount of equity, probably in another form. Not in pure equity funds as Mr. Ron Coutinho has, but probably in terms of equity saving schemes or hybrid equity schemes or dynamic equity schemes, probably. And again, in a quantum that suits their risk profile, and it obviously for a senior citizen as a percentage that quantum will be lower than for the same risk profile a younger person. So I think that is the first part. So I think Mr. Coutinho should take some professional advice before he does any execution. The second part that you mentioned, so obviously when you're shifting from equity, one kind of equity mutual fund to another kind of equity mutual fund, then you don't really need to do timing. You are open for 2-3 days, remember, because even if you switch within the same fund house, when I say switch out from fund A and switch into fund B, I will get, suppose I do it today, for fund A I get the NAV of today and I will get the NAV of fund B T plus 2 the second or the third day after that. And during those 2-3 days, if the markets have gone up or down, if they have gone up, I suffer. If they have gone down, I may gain a bit. So, you remain open even while switching for 2 or 3 days. That I think is one thing. Second, in Mr. Coutinho's case, he seems to be shifting from infrastructure funds to regular equity funds. I think that is fine. He's shifting from hybrid funds, which would have 65-70% equity, to probably pure equity funds that would have 95 to 98% equity. And to that much extent, his equity exposure is going up. Again, that is something he needs to be conscious about. I think he should definitely be doing it as long as he has taken a call on his overall equity and debt allocation. There doesn't seem to be a problem. In principle, when you switch, you don't really have to time. When you switch from the same asset class to the same asset class, you don't really have to time it, as he rightly put it, because you are exiting and entering at the same time. You don't really have to worry about it.
Okay, when you are moving within the same asset class, you really don't need to worry. He's moving from equity mutual funds to equity mutual funds, so he can do so right now. All right, Mr. Roongta, appreciate you giving us your time, patiently answering all the questions and queries that have been coming in from our viewers. Folks, if we've not been able to take your question today, don't worry. You can call in tomorrow, next week. We'll be here 5 p.m. every day on The Money Show to help you out with your questions and queries. I can imagine you may be having a lot of them in your mind. Well, fret not, we'll be here every day 5 p.m. But on that note, very short break on The Money Show. But when we return, we are going to be getting you some important voices that we spoke to all through the day. Ramdev Agarwal, Sandeep Tandon, on where they believe the market could move, what's in store, and whether you should follow buy on dips or sell on rise.